Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Chicago soybeans. Okay, so first a quick look once again at my longer term monthly charts. As I highlighted 9 weeks ago, there had been some very interesting actions taking place. So the market, since as far back as the low seen in August 2024 till October 2025, built a sideways action. I noted this action 49 weeks ago, and I will expand on that part shortly, but I just wished you to see that this sideways action had a breach on the upside in October last year, the market trying to stabilize over this sideways action, originally between about the 2019 today uptrend, which is currently at 980 and 3/4, up to the topside congestion in the 1105.5 area. Now, initially, we seem to have established the basing action around the triple bottom formed over August 24 to August 25, and this is where the caution I gave back last year applies, and I quote, once again, as I have done for quite a few weeks now, feel obliged to caution you on the possibility of a false break higher, end of quote. Well, prices failed in November last year at the mauve 3-year moving average, currently 1153.5, and fell away in December, but turned around again in January this year with an immediate countering bullish thrusting pattern that continued higher into February and is now truly challenging that declining mauve 3-year moving average. More importantly, this now places strain on the major longer term pattern here on this monthly chart, and that's the 2020 to 2024 very large head and shoulders top pattern type. You can see the bright red neckline highlighted for this pattern overhead, currently at 1214 even. And importantly, you can see the targets below for this pattern of a primary target X down in the 907 zone, and the secondary harder to reach target X1 is down in the 624 zone. Please note these are very, very long-term targets and should always be considered thus. But the actions in moving higher, especially if prices can overcome the November 25 high at 1172.5, well, such a move will put the bright red neckline into the frame and not its targets below. Back now to my daily charts, and you can see that same bright red neckline close to the top of my daily chart. Now, in addition to this bright red neckline, 49 weeks ago I highlighted here on my daily chart a bright pink July 24 to October 25 rectangle pattern, which you can see, which is currently at 984.25 to 1108.5. This is the outline of that basing pattern I spoke about in my earlier monthly chart. Now, this pattern had worked until late October when prices punched up through the upper pink trend line, taking most of November 2025 to stabilize over it, and interesting in the process forming a small lopsided head and shoulders top pattern. We saw both the primary and secondary targets achieved on the downside. Now, 12 weeks ago, prompted by the bullish action on Winnipeg canola the previous week, I drew a dark blue mid-December 24 to early August 25 bullish Andrews pitchfork. What is noteworthy about this pitchfork is the effect the dark blue middle tie and above, which is currently 1197.5, had on the market. It was a cap. A pierced cap, I admit, but still a cap over most of November last year, causing that head and shoulders top. 12 weeks ago, I hoped for 3 things that might erode the subsequent bearishness. None of them worked, but in anticipation, I also added at the time, and I quote, if it doesn't, then we have little support until the 50% Fibonacci line, or the August to date move at 1067.25, and the nearby change gap, 1063 to 1070.25. End of quote. Well, the market duly fell to these levels and overshot further on the downside. Again, I anticipated this when I said 8 weeks ago, and I quote, I would add to the mix the rising medium moving average, currently at 1088. Now if these give way, which is possible, then we have nothing until the long moving average, currently 1060 and a quarter, which is 660 and a quarter, and the dark blue lower tine, currently 1078 and 3/4. What is interesting about these two is that they are in the midst of congestion from earlier this year, so that's last year, between about 1061 down to 1020 on the wide, and would likely be a suitable resting point should the 50% Fibonacci line at 1067 and a quarter fail to hold, which it might. End of quote. Well, we saw that happen in early and middle January as the long moving average and the rising dark blue lower tine eroded the bearish incentive and left behind a new pattern, a small mid-December 25 to mid-January 26 double bottom. 3 weeks ago, prices closed above the midpoint of the double bottom and soon after reached both the primary and secondary targets. The market also followed through higher over the bright pink upper trend line. And this now prompts the discussion that is the same as in my longer term chart picture, in that, will prices press on through higher, over the November 2025 high or not? This is the next obstacle on the top side. And so far this week, it seems the market may not, as it formed indecisive actions last Friday, Tuesday this week, as there was a US holiday on Monday, and yesterday. This hesitation is starting to be telling, but there is still time, not much, but there is still some time left. Now beyond these, the other key levels to watch are the July 24 high at 1170, the 2021 low at 1181, and the May 23 low at 1193 and a quarter before we reach up to that dark blue middle tine again. Chicago soybean meal. The peak here in late December last year ended up making a small cat's ears pattern. That's the type of a double top that forms after a steep drop, such as the one we had in late November and December last year. The primary and secondary targets for this pattern were reached 5 weeks ago, halting just under the gold flatlining long moving average, currently at 293.5. Down at the congestion at 290.80, which is within the big old April to August 2020 congestion between 282 and 300. I said about this congestion zone 9 weeks ago, and I quote, "Is this enough to hold it? I'm not sure, but it's enough to make the market think about holding." As further down we have the medium moving average and the long moving average. Thus, from the 50% Fibonacci line at 298 even, down to the long moving average is where we'll see if prices can hold this zone. End of quote. This whole move down left us with some interesting possibilities, as the whole mid-December action from the cat's ears pattern lower, as I said 3 weeks ago, could be regarded as either a bear channel or a possible descending expanding wedge pattern. Well, prices have since broken out of both ideas on the upside, halting at the end of 2 weeks ago actually, at the significant dark blue trendline extension, currently at 313.10, and that's of the July to September 2021 descending triangle. Last week saw a drop down for some fresh ammunition down to the broken upper trendline, currently at 300.40, of the bear channel come descending expanding wedge pattern, before making a fresh attempt higher late last week. These moves last week were enough for me to lay out some targets above for such a break higher. Thus we have a primary target in the 310.30 area, and a target already achieved, then a harder secondary target X in the 318.40 area, and a tertiary, much harder to achieve target X1 up in the 321.70 area. I should point out that should prices punch up and stabilize over the dark blue trendline extension, well, we're in a fairly free area, all the way up to the congestion at 323.30. Then, as I said last week, there is the fly in the ointment, and I quote, "We could just possibly have a horn top, capped by the same dark blue trendline extension, built up over the last 2 weeks. This one is not certain, but the market is starting to seemingly exhibit a possible fondness for this pattern, so please be wary." This week we have travelled further down this road, with the now possible construction of an Adam and Assi end of quote. This week, we're further down this road with an Adam and Eve double top, instead of the original horn top. It is still early for this pattern, but please watch for the trigger level down at 301.50. Finally, this commentary will not be complete without my discussing a portion of my commentary which I have been repeating for 141 weeks, so coming up now for 3 years, is the annual key reversal seen here at the end of 2023. I said back then, and I quote, "I now only need to remind you once again of my words when I pointed out that the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023. I've been living in the shadow of this pattern ever since." End of quote. Now I've also added ever since, and I quote, "There's only one thing you take away from any of my musings, let it have been those words." End of quote. For nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since. Chicago soybean oil. 12 weeks ago I said, and I quote, "With all the activity in the soybean complex, it was time I finessed this daily chart to show a better and clearer view of what is going on." Thus the key pattern here is the newly expanded, sorry for the pun, the newly expanded dark blue April to date, so that's April last year to date, April to date ascending expanding wedge pattern, currently 53.96 to up the top of my daily chart. And that's the end of the quote. This pattern, specifically the dark blue lower trend line, had until mid-December last year acted more as an attractor than an ascending expanding wedge pattern. However, back in September/October last year, the market started growing a new pattern, a bright red mid-October to mid-December expanding wedge pattern, neither an ascending nor descending, just an expanding wedge pattern, highlighted in bright red on my daily chart, and that's currently 47.46 to 54.59. Now you could argue that this is a complicated double or even triple bottom, and I could see your point. It is just that I favour the expanding wedge pattern idea as a better fit for the market's actions. As a result, we have now what I set out to do right at the beginning of this section of commentary, and that is, and I quote, "to show a better and clearer view of what is going on." End of quote. I think this bright red expanding wedge pattern is just that. 4 weeks ago we closed above the bright red upper trend line, and I said 3 weeks ago, and I quote, "A primary potential will be up in the 57.10 area, with a secondary harder to reach potential up in the 59.05 area." These are not yet at least just these are not targets, not yet at least just potentials, but they are worth considering. End of quote. Since then I finessed them into the primary target at 58.10, which was reached last week, and a harder to reach secondary target X1 up in the 60.10 area, which is still live. We have seen progress in this pattern such that I added last week a further pattern and target idea, and that is to look at the whole 2026 action today as a possible bullish halfway hesitation, with now potential to a possible separate target X2 up in the 60.25 area.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.